Welcome, everyone, both those who are able to join us today in person, as well as those of you who are seeing this as a recording. What we're going to do today is first, we're going to go over the secure retirement portfolios, look back at 24, and then looking ahead at 25. After that, I'm going to go over just a few brief points about the economy, and then we will put it all together with all your questions. So anything you can think of, just jot them down, and we'll answer them all. So we're going to go ahead and start with Jeff Warren. And Jeff has always been in charge now for many years of our income-oriented Charles Schwab portfolios, as well as stocks related to what we call the new economy. So Jeff, you want to describe those investments for last year and anything you're thinking about for this year?
Unmute.
There you are.
Okay. Hi, everybody. This is Jeff Warren from the Phnom Penh, Cambodia branch of Secure Retirement. I'm over here checking out potential new offices. No, I'm just kidding. We stopped here to see our son before on our way back to the U.S. So, yes, 2024 was a good year for income-oriented investments, and a lot of that is certainly from the higher yields brought on by the higher interest rates, and so all the funds that we typically use for this, performed well, and so we're pretty pleased about that. And I will say that going into 2025, it looks like yields are going to stay higher for longer. Everything in the income world is dictated somewhat by interest rates, and it doesn't look like those are going to be coming down anytime real soon. So, from the income portfolio standpoint, and I say this, I mean, there's people here on the call that I know that we work together on that, and there may be people that see this that want to investigate income. When we talk about an income portfolio, we're really talking about using stocks, funds, ETFs that are, generally speaking, from the bond fixed income world that produce dividends. We use real estate. Real estate is a perennial income dividend provider, and in some cases, certain infrastructure projects produce steady income. So that's really the objective there. And the other thing about that I want to mention is what we try to do is to take this amount of principal that somebody has to work with, that they want steady income from, and try to create some sort of portfolio that produces these steady dividends. And then that can become cash income every month. So that's really, when we talk about income, that's what we're really looking at. And if that's something that becomes of interest to you, then this is something we should definitely talk about and look at your situation. When we talk about investments, it's what your situation is and what you need as to what investments or holdings need to be put together to make that happen. And so we really don't, there's no pat answer to an income portfolio. I wish there was, it'd be simpler. I'd have a lot less to do, but there's a way of putting it together for your specific situation that has to happen. So that's really what I want to say about that. And by the way, you've heard us before, and you'll always hear us talk about a company called PIMCO, Pacific Investment Management Company, which is out of Southern California. They're really our core carrier for income, for fixed income to produce those dividends. They're the largest bond and fixed income manager in the world. They're, multi-trillion-dollar company. They're very, very large, and we use them extensively because they just are simply they're the most consistent company that produces dividends that we've ever worked with, certainly. Okay, so that's a couple of thoughts about the income portfolio, and like I said, last year wound up being very good. And what's a good year on income is that we have some gains, and that all of the dividends, as advertised, were paid every month, and accomplished the goal. So from that aspect, it was good. The other thing I want to mention before Richard talks about the tactical allocation portfolio is another side of what we do is, and we've kind of borrowed the word or name, the new economy, to describe it. If you look at what's been happening in our world over the last, it's been decades, but it's really gone into kind of high gear over the last several years, is we're having multiple transitions that are really, really large. The first one is the transition on energy. And so much of that transition is to reduce carbon in the atmosphere. And that is usually thought of as clean energy. And when you think of clean energy, you think of the traditional solar and wind, but there's a lot of additions to that are getting a lot of attention now. Nuclear's kind of come back into vogue. There's a lot of big companies that are actually starting to build nuclear again. It's very clean, the energy from it, regardless of the whatever we think about it. But that's the reality. So you get that piece of it, and then all the fuels that they're trying to develop, particularly green hydrogen. But the fact of the matter is, today, most of what we do as people and societies is still run by a fossil fuel, whether it's oil or natural gas, et cetera. So there's this massive transition throughout the world going on. And what that really brings to light as an investor is there's a tremendous amount of capital being committed to this particular area. It's now in the trillions, and that will not stop, regardless of what what administration is in office, because price of energy is what drives use and demand. And so we've got a huge wave that's happened. And also the last administration put into play a bill called the Inflation Reduction Act, which really is several $100 billion committed to incentives and public capitalization of clean energy build out. So the energy transition is a really big economic event that's occurring and continuing to occur. The other thing is digitalization, and I think it's interesting. That's only been going on for about 30 or 40 years, but COVID, when everybody was now living in front of a computer, and doing everything, quote, online, uh, it took on a whole kind of almost like a whole new life. And so the capitalization to keep building this highway, for data and for connectivity is the growth of it is unbelievable and will continue to be. So yesterday I read from Bloomberg, and I saw the picture of Trump standing in the White House Oval Office, with some executives from the AI world and digital infrastructure world, and he was talking about a new $100 billion fund they're putting together to help develop AI infrastructure. And the open AI guy was there, and Larry Ellison from Oracle, and but the main point I want to make is about this whole area. You hear about AI constantly. It's a front of mind, front of headline topic today. But what we look at for the investment purposes and for what the kind of investing we like to do is this is infrastructure, trillions of dollars of infrastructure that is being developed and will continue to be developed. And so we're just kind of following the money, quite frankly. It's really not that complicated. We also have infrastructure, the traditional infrastructure that's being built at a new level. That kind of got fired off with the infrastructure bill that was passed in late 2021. So there's these literally trillions of dollars of public and private funds that are going to this new economy. And so from that vantage point, it's just a good place to have some for growth, for future growth. And I do want to say this: the funds and the companies that we utilize, these are, I'm going to call it, for lack of a better word, buy and hold. The idea here is to find these really strong companies that are kind of at the forefront of this, who've got experience and look like they're going to be there for a long time going forward with this, is to buy them and hold them through this transition, through this cycle. Now that might be 3 years, 5 years, 10 years. That's a real moving target. But I think if you're going to invest in this kind of growth, and that you should be thinking, I'm going to call it long term. And long term has different meanings to people, but generally speaking, these need to be thought of as 3 to 5 year holds for sure. So you can get the benefit of investing in them. So I research this constantly. We've got about 40 holdings right now that we work with in building portfolios that are in these two areas. And so I guess the takeaway from me is to you is, if this is something that's kind of interesting to you, you think is got potential, and you want to look at it, it's just a discussion. We just have to have a discussion about what you want to accomplish, because that's really what this boils down to, is what do you want to accomplish. So from that, I will conclude my little remarks, and I really appreciate, I see everybody here. I appreciate everybody here, and I look forward to being on U.S. soil again and and hopefully seeing you soon in person. Okay,
All right. Thank you, Jack.
Richard.
All right. Amber, can you start our little slideshow now, please? I'm going to talk fairly briefly about the tactical allocation portfolio, defensive
Sorry,
growth.
can you, sorry to interrupt. Can you see my screen? I just want to make sure.
Yes.
Okay, great. All right.
Okay.
Okay.
So our first slide.
You gotta see it.
Can everyone
Yeah.
see it?
Yes.
Okay,
Okay.
great. All right.
All right. So our first slide, if you move ahead there. For the tactical allocation portfolio, what you see on this screen are the 7 largest holdings at the end of the year and today as well. And the one on top, Campbell Systematic Macro, which went up 10.81% last year, is our largest holding. PIMCO Income, the second largest, etc. If you look at this, you'll notice there are stars beside 4 of these, the number 3 through number 6. And those stars indicate that those investments were made mid-year. We didn't own them from January 1st. Whenever I'm investing, my number one goal is, I think, to always learn from past experiences. In 2022, and then again to a lesser extent last year, had we owned everything we ended up with the whole year, we would have made twice as much money. So had we owned number 3, 4, 5, 6 there from January 1, we would have made twice as much money. And in both 2022 and last year, what happened is that we are heavily into the asset class called managed futures. And managed futures have very unique properties. The reason we're so heavy into them now is they make money when markets are volatile. Well, there's so much uncertainty because of the election and everything going on. More uncertainty perhaps than I've ever seen, I think anyone has ever seen, when it comes to markets, economic things. That uncertainty leads to volatility in all kinds of markets, especially commodities and interest rates and currencies, as well as stocks and bonds. These funds, because they can invest in anything basically all around the world, even if things are quiet here in the United States, for example, no risk in our markets last year, at least no obvious risk. That doesn't mean there weren't great opportunities going on in other places in the world. And so with these funds, what I've learned is, if you think volatility is going to increase, you need to be ready in advance. You see, the markets they make their money in, I mentioned currencies, commodities, for example, those are really volatile markets. When they start making money, they can make a managed futures fund. They can make the entire year's profit in a few weeks or one quarter. So the lesson that's for me has been, make sure you're ready right from the beginning if volatility indeed is likely to increase. On the other hand, what if we just have a repeat of last year? Well, we want funds that also can and have done well when risk isn't anywhere on the horizon. Well, it's on the horizon when it doesn't strike that year. So we want that combination. And had we owned these all last year, it would have worked out beautifully. We still had profits, just not as much. Should we have a repeat of what we saw last year, we would indeed be making more money from the get-go. Every year, usually in January, start of the year, I do a thorough, research on every alternative investment that we could use in this fund. And this year was no different. I went through every alternative mutual fund every managed futures fund. There's like 4 or 5 different kinds of alternative funds. They all control risk. Some of them go more into stocks, some less, some of them, invest in everything around the world. So I looked at all of them, a few hundred, analyzed them, made a list of the best 5 that we don't currently own. By the way, if you do that study, Campbell's Systematic Macro comes out #1 every time. The interesting thing was I found 2 funds that really can add value. Can you go to the next slide? One of them is called Camelot Event Driven Fund. Now, this would be very different from anything we've owned in quite a while. For example, it's 70% in stocks right now. Am I throwing the baby out with the bathwater here? Am I ignoring the fact that stocks are more than a little bit overpriced? No. This fund actually has underpriced stocks in it. I wasn't even sure there were any, but they have found them. Plus, and this is the main reason this fund jumped out, merger arbitrage is the main event where they make the most money. That's when companies merge together. And the last 4 years, the Biden administration was putting the kibosh on a lot of mergers due to antitrust reasons. Apparently, everybody says that this new Trump administration is going to open the doors to mergers left and right. That's how this fund makes a lot of money. But number 2 is this fund makes money from distressed opportunities. What does that tell us? That tells us that when things get bad in the economy, things start to contract, they have opportunities there where they can make good money. So, and then number 3, if you look at everything they own, you'll notice that quite a bit of their stocks are in gold and silver mining companies, a very defensive type of asset. Very good fund. It has tended to do quite well when stocks did well, with very good downside protection. And then a second fund we're looking at adding to the tactical allocation portfolio. If you can go on to the next slide. The next fund is called Abbey Capital Futures. We're looking at switching out in this portfolio PIMCO trends in favor of this fund. And the reason is because trends just hasn't done nearly as well as our other managed futures funds. This was a funny story. When I looked through all those hundreds of funds to pick the best managed future replacement, the one I came up with was Abbey Capital. And then out of the blue, Abbey Capital's West Coast representative called us up and said, "Hey, I want to have lunch with Richard." We had lunch yesterday, and I had found Abbey Capital as the best futures fund that we don't currently own in the whole country. And I found myself sitting down with their West Coast representative, and I didn't even know that they were connected. It was important to me, though, because that particular representative is the most knowledgeable about quantitative and alternative investing of anybody else I know in the industry. So the fact that he supported it alone would have been enough, but my own research showed the same thing. That's all I'm going to talk about for the TAP portfolio right now. And we're going to turn it over next to a very special advisor, our newest, and Amber Jenkins. Amber, being younger than Jeff and myself, has been developing a new tactical allocation approach that is basically very similar principles applied differently for a more aggressive type of investor. So Amber, take it away.
Thank you. Yes, hi. And for those who weren't at our client appreciation event, I'm now an advisor. I got my license in January of 2024. And since, I have been sifting through the massive amount of information out there, finance, there's just, it's like a huge ocean of stuff. And because I've been looking for something to bring to the table that's new. But that also
we would deal with and
will align with let me move will align with Richard and Jeff's views on macroeconomics. And so I was blessed to find a brilliant man, Darius Dale, who it's called Macro 42. And so I've been studying with him and pretty much copying his growth oriented portfolio. So we can offer this to people who have a longer time horizon and are willing or wanting to take more risk. And so it is also macro approach and risk management focused. So it's designed to protect your assets during market downturns and to react quickly to market shifts to preserve your gains. So he does do more trading than you'll see in Richard and Jeff's accounts. It's not a long hold, but it's always to capture your gains and avoid risks when the sales take place or the shifts in the portfolio. And it's a superior, long performance compared to the 60-40 portfolio, which is common, 60% stocks, 40% bonds. It's back tested to outperform that, and the portfolio's trend following approach maximizes growth. And oops, sorry. Shoot, of course. Oh, let's see, how do I go back? Okay, don't want that. Okay, there we go. Okay, and so the portfolio construction, it's very simple. So at all times, 60% stocks can be allocated, no more than 60%. Well, we go into stocks, and 30% gold is the maximum amount in gold, and 10% in Bitcoin. So those are the main asset classes that the portfolio is in. And in times of risk, it can go up to 100% in cash equivalents. So a cash fund that does also have a yield. Like right now, the cash fund is yielding 4.8%. So, and then it's specifically designed for anyone with long-term time horizon who has money to put away for retirement. It's focused to help you retire on time. And yeah, that is all I have to say for now. And if you're interested to hear more, you can meet with me. And yeah, or if you have children who you think may be interested, send them my way.
Thank you, Amber. And by the way, I've been having a lot of fun with Amber's new portfolio because every day she'll come in and say, here's the recommendation. And I've been reverse engineering it every time, thinking, okay, and every time it makes perfect sense. And he's doing it for the same reason I would come up with. The difference is it's really short-term based. That definitely adds more volatility and uncertainty, but thus far I've been quite impressed. And one that I really like about it, any trading strategy has to be obviously first based upon huge amount of history, so you know what you're doing makes sense, but then it has to be followed rules based. I mean, the implementation is everything. Over and over through the years, I found trading strategies and hey, this looks real good. It makes sense. Then you look at the returns from the people getting that research and they're half as much, or their losses versus gains. And in each case, the person selling the research was telling the truth. In other words, if you did exactly what you were told to do, it did work. Although, just got to warn you, Amber and I have also already been thinking up ways to modify it. Following their rules, though, would be sacrosanct. That's the key to any investment discipline.
And I want to add one more thing. What I like about it too is it has some crypto in it. And just, you feel like you have some skin in the game in the crypto world, but it's a very simple way of investing in crypto with a Bitcoin ETF. So we also, like Jeff has a Bitcoin ETF in one of his account or a few of his accounts. So also if you just want to put a little Bitcoin in your account, we can do that for you as well. Jeff can, Richard can, and yeah.
And the reason I like that fund as a potential Bitcoin owner is because 0% in Bitcoin is always not just on the table for them, but we've already seen them go 100% in and out.
Yeah.
With real volatile assets, unless you're willing and able to go in and out. By the way, anybody who thinks it's easy to do this type of short-term asset allocation, it is not. But this guy is very impressive. So thank you, Amber.
Thank you.
All right, we're going to end the formal part here with a very short economic view. I sent out a report here a couple weeks ago that talked about battling economists. We compared Mark Zandi, the chief economist at Moody's Analytics, who was very, very gung-ho on the state of the economy, versus Dr. Lacey Hunt, generally considered the greatest economist in this country, who sees things the exact opposite. Instead of repeating what Mark Zandi says about the economy, I decided to replace it with something I found this morning from the Bureau of Economic Analysis. I found this very interesting statement because it's supposed to be a totally nonpartisan entity. The Bureau of Economic Analysis, Bureau of Labor Statistics. They're the ones who give us all our economic data for the most part. So they're supposed to be nonpartisan throughout all administrations. Here's what they said yesterday about the US economy. They say the economy's grown 12.6% under the Biden and Harris administration, with the lowest average employment of any administration in 50 years and 16 million jobs created. This demonstrates stronger economic growth than during any other presidential term this century. There's so many holes in that statement. The first one being a nonpartisan group. When I read that, the only thing I knew for sure was that whoever wrote it will not have a job by the end of this week. Okay, because that's out of bounds. However, viewing the economy positively is not out of bounds. If you turn on CNN, Bloomberg, Fox Business, CNBC, you'll hear the description of the US economy as one of the best ever right now. You'll hear it 100 times, and maybe two people will have a little different view. That's where we're at. That doesn't change the facts, however, and I'm just going to quickly tell you Lacey Hunt's facts that dispute this greatest economy ever idea. His response to that was an article called "America's Wage Earners Are Being Crushed." I couldn't believe what I read. Lacey Hunt is the most renowned economist in this country. I know for a fact he's a lifelong Republican. Okay, he does not let politics influence anything I've ever seen him say or write, but I know that. Well, one thing I've rarely heard Republican economists discuss at great length is something called income inequality. And he said that there's something terribly wrong with our economic calculations these days. He says economic growth is now broken. He looked into it, and here's how it's broken. Yes, our economy, it has been growing at about 3% a year, which is roughly double most of the rest of the developed world. We're definitely doing better than other countries. And yet, 80% of our citizens think the opposite. What's going on? Well, he looked at all the numbers and it's pretty clear what's going on. He showed that almost all of the growth is going to the top 20% of our population, with the vast majority of it going to the top 1 out of 1,000. The remaining 80% of our population, they're the ones who are saying the economy's terrible, they don't have enough money to live. So yes, if we add everybody all up together, we're doing pretty good, certainly better than the rest of the world. But if you actually look at the people in this country, the average person is far below where they were a few years ago. I'm not laying the blame in any one place, and neither does Lacey Hunt. In fact, and this was, well, I'm going to get to his conclusion in a second. One other thing, there's just no way in the world this is a good employment market. The last government statistics that have been revised enough so that the government says, you know what, these numbers are real, okay? The last quarter they have real numbers was actually the fourth quarter of 2023. And in that quarter, we lost 250,000 full-time jobs. We gained 500,000 part-time jobs, no employment gains whatsoever. We just traded, in that one quarter, we traded 250,000 full-time jobs for 500,000 part-time jobs. Last year, the same thing happened because the total number of hours worked in this economy went down a little bit. And so when the number of hours worked goes down, you know it's not a very good employment market. When last year we probably lost 1 million full-time jobs, 250,000 a quarter on average, and gained roughly 2 million part-time jobs. Okay, so those are the facts. That's a really bad employment market unless you think there's too many full-time jobs. Actually, if you owned a major corporation, it's a great employment market because now it's becoming so common to be able to fill positions with part-time people with no benefits. So this works real well for business owners, works real bad for the people. So that's going on. And then the thing that really struck me was that at the end, the interviewer in the asking Lacey the questions said, okay, Lacey, how do we get out of our problems? And by the way, I skipped the biggest part, which is called, you guessed it, the problem is debt, too much debt. He was asked, how do you get out of it? And there were 5 ways. You could raise taxes, you could cut spending, you could grow the economy so revenues went up, you could debase the currency, or artificial intelligence will lead to an immediate renaissance in the US economy such that all our problems disappear. Lacey Hunt took everything we could do to get out of our current difficulty economically, and he showed they're all impossible. None of them are going to happen in this political climate. Even if they did, it wouldn't work. Because eventually, when you get too much debt, the only way out is to resolve it. Well, those are called losses. That's what we've been trying to avoid. By we, I mean the government and the Federal Reserve Board. They've been trying to avoid ever seeing the debt losses that exist in this economy. They will come to the fore. First place that might blow up is called commercial real estate, because it already has. Downtown commercial real estate in our big cities is off about 50%. But the loans that have come due, they haven't called it a default yet. Until a bank calls a loan a default, no loss exists. So there's big losses there. There's a whole bunch of places this year where a lot of things could go bump in the night. Anybody who thinks they can guess which things will go bump and what else they'll bump, it would be just wild guessing. All we know for sure is there's so many opportunities this year for serious economic and market confusion, problems, etc. Be prepared for anything is what we would say for this year. So with that, I want to open it up for questions. So some of y'all must have some good ones.
I have a question.
Please.
So when you say in alternative investments, what can you define that?
Yes. Basically, it's anything other than a stock-based, a stock or a fund of stocks, bonds or a fund of bonds. It's not a commodity itself. Okay. It's let's see. It's none of the just regular buy long in your asset class. Okay, so you're doing something different. Now there's a lot of types of different ways to invest. They all have some way that they control the risk level. And most of them use the same way I use, the same math, but they all try to control the risk. Then they all have different approaches to trying to capitalize opportunities and avoid, problems. So they do a lot. Alternative investments usually do more trading than normal. They go into markets that other funds normally don't do. And that's probably the most important point in alternative investing. If a person has ability and a record as a trader, stock trader, for example, any type of securities trader, commodities, interest rates, and currencies are big opportunities. It's just that a normal person can't do it. Okay, if you and I and several engineers and PhDs who are our clients, we would have to spend decades developing a trading program in those areas. It's hard. Well, these guys, the alternative arena is where you find those traders. You find people who can capitalize going long or short, doing a lot of different types of things. And normally, alternative investments, maybe 20% of a portfolio. I think you can easily make a case for 2 or 3 alternative funds to diversify from stocks, bonds, real estate.
So in ours, what is in the tactical portfolio, is there an alternative one there now?
Oh yeah, it's about 70% alternative.
So the managed futures are considered?
Oh yes, the managed futures and the Hermes Equity Long Short Fund is another one. The 2 I just showed for this year, the 2 new ones,
Those seem.
they're all alternatives. Normally that should be 15 or 20%, let's say, of a portfolio. Most people have 0. But on an ongoing basis, I definitely can show you how that can be superior to a 60% stock, 40% bond, that type of portfolio.
Mhm.
So, but we have so much more because these are not normal times. Okay. I would never have this much in managed futures, except the markets are more overvalued, more stretched than any time in US history. So I'm trying to capitalize on a big reversal.
Mhm.
When that happens, at the end of that, we'll look at everything and say, do we want any of these alternatives? We'll probably keep 1 or 2.
Mhm. My other question, in a nutshell, Bitcoin, if you could just define it. I had heard it was a scam and then it's not, and all sorts of things. So
Okay, Bitcoin is either the most hyped up pet rock ever, or the most wondrous get rich approach ever. So it's one of those two. If, you know, ask me this question in exactly 5 years. And then
Well, it's wanting to be a currency. That's
it's
the,
wanting to be a currency. The problem is that the definition of a currency, the only real feature you have to have in a currency is stability. Okay. And Bitcoin being the least stable asset in the world might have a little problem with a current as a currency. Number two, the other concern is the fact that every time risk hits, it gets killed. So if you study the correlation between Bitcoin and big tech stocks, you'll find that correlation is 0.99. In other words, you could own Bitcoin or you could own Nvidia, Tesla, Apple. It's the same, it's essentially the same thing, only Bitcoin is on steroids because it's even riskier than they are.
Like, do you buy things with Bitcoin, or do you just invest in companies with it?
The vast majority of it now is people just investing in it.
Okay.
Okay. And so, by the way, even though I talk about the negatives and the risk involved, when I have clients in the tactical allocation portfolio, and quite a number over the years, quite a number of clients have said, Richard, I also want to own some amount in stocks. Sometimes they've said, hey, I want to own these 3 stocks. So we own those 3 stocks. And so these days, anybody in the last year who said, Richard, I want to add some stocks to my portfolio, generally, basically, I'd come down to a fund called the Magnificent Seven. It's a exchange traded funds that owns the most 7 overpriced stocks in US history, because that's where all the profits have been. Those are the companies benefiting the most from artificial intelligence swings, et cetera, et cetera. Do I think that's a wise long-term view? Obviously not. But if a person says, hey, I want to make a lot of money starting right now, that's your best bet. I don't mind doing it because in each case, the person knows that if things start to fall apart, we'll be talking. So.
Rather than.
and can I just add about Bitcoin?
Oh, yeah.
Some retailers do take Bitcoin, and on certain exchanges on platforms, Bitcoin is used. And that's all I want to say.
Plus, there's obviously a big upswing in cryptocurrencies due to the new administration. Big focus. I mean, they love it because it's a way to create apparently unlimited money out of thin air. So it's big right now. And
That's part of the deregulation in the administration. Is part of it is deregulating what has blocked crypto from being able to grow and become a more common currency.
That's correct. And so as long as today's markets are happening, yeah, it makes sense to own some if you are okay with the volatility in today's market.
Just one thing, wouldn't baseball cards and its ilk be a more fun thing to do rather than going off on Barnum and Bailey's stuff?
You know, if you look at collectibles,
Yes,
that's been a really good market. Yeah, I have one that I was speaking with a collectible store in St. Louis. We had a client once upon a time who was in AAA for the St. Louis Cardinals, and Stan Musial gave him this beautiful thing with a jersey, a bat, a ball, all kinds of stuff, and he gave it to me.
Wow.
I'm trying to sell it.
But you're a Cardinal fan. As a Cardinal fan, that's something you should take to your casket.
Oh, nobody else. I'm the only Cardinals fan in my family.
Thank you, Richard.
All right, other questions, folks?
I have a question for Jeff.
Yes.
Hi.
Hey
So
there.
Jeff, you said we're in the middle of a massive transition of energy to clean energy. that won't stop regardless of the administration. And at the same time, I hear our new president saying, drill, baby, drill,
Mhm.
which seems to be oil and
Mhm.
not clean energy would seem to be his focus. Can you help me understand? That sounds like a conflict.
Well, yes, and also you got to realize that it's called talking. He's just talking. The reality is you have to follow the capital. Where is the capital going? And the biggest amount of capital by far over the last few years and continuing to grow is going into some form of clean energy development. And here's the other thing. At the end of the day, this is a commodity. Energy is probably, I guess, energy and water are our biggest commodities that that exist. Price, ultimately, it's a supply demand issue, and wind and solar, for example, are so much less expensive now than our fossil fuel, counterparts. Now, you got to, and also I mentioned though, this transition is a massive long-term event going on. We're still 80+% dependent on oil and pretty much natural gas and coal. We've only made so much progress in this energy transition to clean sources. But that's where the capital, the biggest amount of capital is going. Also, the chief executive officer of Exxon was asked about this, the drill, baby, drill and all that. He said that's not really a good idea because of the investment part of it. The big majors, many of them, they're diversifying. They're putting capital into a lot of different areas of energy development and research. So I guess that I hope that's not a too fragmented of an answer, but this is happening and it's going on. Greenbacker, a company that we work with that does renewable energy, they did a paper at the end of the year based on the new administration. They were trying to help investors see that this red state, blue state thing, most of the capital, jobs, and development of clean energy is in red states. That's so if they, I don't think they're going to go in and tell all these municipalities and counties and cities and all these people, take it back. We want you to go back to work at the dollar store.
And can I add one thing to that, Jeff? Is
Yeah.
that the need for energy is increasing with AI. So
Yeah.
the
Oh.
amount of energy that we are going to need to, power these computers and the super chips and is increased exponentially and will be needed even more and more in the future. So other ways of finding that energy is a need.
Good point, Amber. It takes so much more energy for the computing power of AI, and I mean by a lot. And the big companies, the Metas and the Googles and the Microsofts and the Amazons are building these giant hyperscale data centers, and beside it, clean energy resources. Because if they just use dirty energy for this massive amount of demand they have, they look kind of bad. So so anyway, it's a big topic, but it's all part of this new economy, all these transitions, and nobody knows exactly what's going to happen. We just know that that's where all the monies go.
I-
At
I-
this-
I- that-
You answered
way,
very
very
well,
good.
thank you.
Okay,
An
thank
interesting
you.
point on electricity. Okay, so we know AI uses a ton of electricity, right? We know the government claims the US economy grew at about 3% last year. We also know that electricity usage in the United States went down last year. Falling electricity with burgeoning AI usage of electricity? What that means, and by the way, electricity usage has a 0.989 correlation with economic growth. Okay, that's the only way, it's one of the only ways President Xi in China, it's the only number he trusts to see growth in their economy because he knows that's a real number. When the economy grows, electricity use grows. It's been shrinking last year. So that's a weird thing. Other questions, folks? Anything else come to mind? In that case, we'll go ahead and conclude. If you have other questions you think of later, give us a call, shoot us an email. And it's great seeing you. I hope you all have a best year ever. Feel safe in saying I do not think this will be a boring year. All right. Thank you all very much.